Hi everyone. In this video, you will be learning the basics of accounting. This video is the stepping stone of my upcoming lectures on financial instrument and their accounting. And this is the stepping stone of anything you want to do in accounting. So this is the very basics that how we do the accounting, or basically I would say in this video you will be learning the basic bookkeeping. So here I am, your tutor. I am Ishan Thakkar. I am a commerce graduate and a chartered accountant with an experience of 7 years with leading investment banks in finance and accounting departments. So let's get started. So to learn the bookkeeping, you just need to learn the simple two rules. Very simple two rules. Let's take it as a game. Let's take it as a game. The game is you every transaction you need to find in every transaction you need to find two accounts. You need to find two accounts, at least two accounts. And then one account will be debited, another account will be credited. That's a very simple thing. Okay. So of now the question arises, what is account? That's a very basic question. So account you can relate with it is a very basic thing. Like you can take it as a diary where you will record all the things happening for that diary you have maintained for. You will maintain diary for each and everything, and you will divide this diary into two parts. One part is debit, another part is credit. Okay. So whenever any financial transaction incur, so mark my words. So accounting is done for only financial transactions. Okay. So accounting is done only for financial transaction. So let's suppose you go for an interview and they say you enter into an agreement. You enter into an agreement. What is the basic journal entry for this? Let's say what accounting will you do? There is no accounting because there is no amount involved. There is no financial nature of this thing. It's just an agreement. Okay. So there must be some amount, I would say, should be involved. Okay. So you know the rules. There are two rules that it should impact the transaction, should impact at least two accounts, and if you're debiting one, another should be credited with same amount. Okay. So let's start with few of the examples. So let's say you started a business with a capital of rupees 10,000. Okay. So you started a business. So if you don't know accounting, let's say you will be recording everything in a diary in a layman language. You will record rupees 1,000 capital introduced. Okay. You are maintaining a diary at the end of the day just for record. So you say 1,000 capital introduced. Okay. So in your business, what financial thing is happening? So now you have started a business. So you bring cash as a capital. So you maintain a diary for one thing. One is you maintain a diary for cash. Okay. In this diary, you will be noting all the cash transaction. So once you introduce the capital to start a business, so what two accounts will be impacting? So what two diaries you will touch? So one is the cash, okay, and another is the capital, okay. So, and the second rule is, so I found that the two accounts or the two diaries that I need to touch is one is cash, another is capital. So, and if I write cash here, then another account should be credited. So, capital should be written here. Now comes to the, let's look at another example. You feel that this 10,000 is very less amount to do any kind of business. Okay, this 10,000 is very less amount. So you take a loan. So you loan taken from bank. Let's say you take a loan of amounting to 10,000 only. So you take a loan amounting to 10,000. So what will be the what two accounts will be used here? So you take a loan, so you have an obligation. So you need to maintain an account, I would say, or you can say a diary, where you will note down how much loan is left. So you maintain a diary of a current loan. And what other things is happening? You get a cash. How much cash you're getting? 10,000. If you're writing 10,000 here, then if you're writing debiting, so the other account that you have found should be credited. Okay. Okay. So you are planning the things, and then you see you need to pay the rent of the premises. Let's suppose the rent of the premises is 100 rupees. So what two accounts will you open? One is obviously the rent, I would say. And if you're writing 100 here, and what other account? You are paying cash, cash is going. So, which two accounts you will use, or which two diaries you will use to record this transaction? That is, the transaction is rent paid. So, the transaction, if you are writing 100 of rent, and what another account you will use? So, you will use cash. So you will use, if you're writing a debit in here, so another account should must be credit. That is the basic rule. So this thing that every transaction must be recorded in two, at least two accounts, and equal, and debits and credit must be equal. So if you are debiting one account, another has to be credited. So if you're debiting 1,000 rupees in one account, there must be some other account or two accounts or three accounts where you are crediting that 1,000 rupees. That is a very basic rule. Okay. Now you need to, you got this point. Okay. Uh, we can take a few more example. Uh, you pay the interest on the loan you have taken. Okay, so what is the transaction happening? Interest on loan paid amounting to rupees, let's say, 1,000. Okay, so for this, to record this transaction, what two accounts you will be touching? One is you will maintain a new account, a new diary, to record a new kind of expense. So the new kind of expenses what we call it as interest expense. Okay, so if you are debiting 100, then you have to credit something, right? So interest is going out of your pocket, the cash is getting reduced, so other account is cash. Um, this amount, 1000, I believe. Yes, 1000. Okay, so these are the basic transactions, and here you can record the first is capital, another is loan, another is rent, and second is interest expense. So look at the diary. So few things are recorded here, few things are recorded here. Okay, capital in cash, rent you pay cash, loan you get cash. Okay, so yeah, interest you pay cash. Okay, these are the very basic how you record the things. So the question coming to your mind is what will be debited and what will be credited? That you learn in some time. So first you understand how the bookkeeping is done. You start a business, you open various ledger accounts, and each account you will keep posting the uh, transactions. So, and if one thing is debiting, another thing must be credited with the same amount. So, debit and credit must be equal, and there should be at least two accounts. And this thing is called as double entry bookkeeping. Okay. So, after recording this transaction, so if at the end of a time you want to see what is the summary of all the accounts, you need to know, then you cannot scroll all your diaries or all your accounts. There is a statement that you prepare which has summary of all these accounts. That statement is known as trial balance. Okay, so in this it also has two sides. One is debit, another is credit. So at debit side you will note all the debit balances. So cash, just tell me if it has a debit balance or credit balance. Simple thing. It has debit of 20,000 and credit of 1100. So you are left with 18,000. So the cash you have left with 18,900. Am I right? 19,000 and 20. Yeah, you're left with 18,900. So you have a cash of 18,000. So is it a debit balance or credit balance? Just tell me. So you have debit of 10,000, credit of 1100. So the debit is more. So you have a debit balance. So cash is 19,000. Oh, sorry, is it 19,000 or 18,000? 18,900. Okay. And you have rent. Debit is 100, credit is 0. So you have a debit balance or credit balance? Debit balance. So you have rent of rupees 100. Let's say another account. Loan. You have credit of 1000 or debit of 0. So you have credit balance. So you have credit balance of loan amounting to 10,000. Okay. And then you have capital. Is it debit balance or credit balance? You have credit, nothing is debited. So credit balance. So you will write it as credit side. Okay. Okay, let's what other account? There's this covered. Another is interest expense. Interest expense is debit or credit? Here is debit, credit is zero, so it has a debit balance. So interest is you will write it here at debit side, that is interest expense, and amount is 1000. So the trial balance must tally. So if you follow double entry bookkeeping, your trial balance must be tally. Okay, so 19, 19 or 20. Perfect. Okay, that is the basic concept of bookkeeping. So you open accounts and at the end you record all the balances in one statement, which you call it as trial balance. It has summary of all the accounts. After this trial balance is made, you prepare your financial statement. That is the end result of accounting. Accounting ends after the financial statements are prepared. So the net result of accounting is to prepare the financial statement. And to prepare the financial statement, you will divide all these balances. You will take all these balances somewhere. So the two very basic thing financial statements are, one is balance sheet and another is profit and loss account. Okay, so how you prepare a balance sheet is, the balance sheet has two sides, nothing debit, nothing credit. One side is assets and another side is liabilities. Assets is something on which you have control and you derive some future economic benefits. Liabilities are your obligation that you are bound to pay. So these are the very basic definition. So if let's see what fits in here. So loan is 10,000. Is it your asset or is it your liability? That loan you're bound to pay. It is your obligation that you need to pay 10,000. So you will write it at the liability side. Loan is 10,000. Capital. Capital is something which is introduced by owner to start the business, and it is nothing is paid. There's no fixed payment of, I would say, interest or something. No fixed payment is there, but the residual profit is the owner's right. Okay, after paying all the debts. Okay, so let's forget it. So capital is a liability towards honor, you can see. Okay, so it's a liability. So you will write it here 10,000. Okay, okay, let's see. Next is cash. So cash is obviously it's your asset. You control it, and you enjoy the future benefits. You can take anything. So you have cash, and the amount is 18,900. Rent. Are you getting any future benefit? You get the benefit in the past. So nothing. So it is neither asset nor liability. Interest expense. Is it asset? No, it's not. How can it be asset? Nothing. So it's your neither asset nor liability. So you take it here. and then you prepare profit and loss account. Profit and loss account is nothing but income minus expense. So what is your income here? You will find all the income accounts. Is rent paid your income? No. Is interest expense your income? No. Is interest expense your expense? Yes. Rent paid is your expense? Yes. So the interest, so you made a zero income and expense of 1100. So by doing this business, you made a loss of 1100. Okay. So that 1100 you need to adjust from the capital. If it would be profit, you add it in the capital. That is the owner's right to have the profit. Or if it is a loss, the owner has to absorb it. So you will subtract or add here. So it is a minus, so you will, it is loss, you will subtract it here. Okay, so net profit or loss. So you will be see how your balance sheet. So that is accounting. Very simple. Accounting is done. Accounting is done. That is how accounting is done. Okay, I hope it's clear. Now you must be wondering what the question that was left is what needs to be debited and what needs to be credited, how the debit and credit follow. So I tell you, every account that you open, every single account will fall in this six words. No account, no account will be beyond these words. And the rule is uh, whenever there is increase in asset or increase in expense, whenever there is increase in asset or increase in expense, you need to debit. Whenever there is increase in liability, increase in income, increase in equity, or you can say capital, or increase in revenue, it should be credited. That is simple. What needs to be credited? So these accounts will have debit balance and these accounts will have credit balance. So let's see the example we just did. You started your business with the capital of, okay, let's do it again. You started your business with the capital of rupees 10,000. Okay, so the asset is cash that is increasing. So you are debiting cash account. So we prepare ledger like this. Cash, you debited cash here 10,000, and another is equity. So your capital is increasing. So capital should be credited. So you remember um, capital. So capital should be credited. So capital is increasing. So capital should be credited. So if you want to write this in a finance, we do this by journal entry. So what will be journal entry and how you write it? So your asset is increasing, one thing is debiting. So you write cash account debit to capital. Okay. So to record this, you will pass this entry in your box. So cash account debit to capital 10,000 and 10,000. Another thing, another transaction that we did is we have taken a loan of 10,000 from bank. Okay. So the 10,000 loan is your liability that is increasing. So loan must be credited and you're getting cash. Same cash account debit to loan. Simple. Okay. Now move to next. We pay a rent of rupees 100. So what is increasing? Your expense. So rent account debit. What is decreasing? Asset to cash. As simple as that. Next, you paying interest on loan. So what is increasing? Expense, interest account debit to cash. Okay. So what is debiting? What is crediting? You can see here. So we introduce a capital. So cash is increasing. We debited cash. Uh, then cash increased by loan. We debited cash. Capital is increasing. Equity increasing. Capital should be credited. Loan liability is increasing. Liability should be credited. Rent expense is increasing. Expense should be debited. Interest expense is increasing. Interest should be debited. So this is the basic. So how things are done? So when we go in a large organization, everything is done through system. Everything is done through system. You need not to prepare, do anything. So everything flows through a system. But sometime, some transactions are left to be recorded by a system. So you need to put in manually into the system. So you don't follow all the things, you just pass a journal entry. So in the upcoming lectures, I'll be more focusing on the journal entry. So what journal entry you will prepare? So you just remember all these things, that how to pass a journal entry. So the simple rule is, when asset is increasing, you need to debit the asset. When expense is increasing, you need to debit the expense. When liability is increasing, you need to credit the liabilities. When equity, you can, for the time you can remember is equity. When equity is increasing, equity you can take it as capital for the time being. So when the equity is increasing, it should be credited. When the income is increasing, it should be credited. When the revenue is increasing, it should be credited. Okay. Now, what is equity? Equity is the residual. So I tell you, balance sheet. Here are assets. Here are liabilities. So after paying all the liabilities, after paying all the liabilities, whatever left from the asset, if you subtract the liabilities, whatever left is the equities. So the owner's right is the equity. So when it comes to payment of the liabilities, first come the debts or the loans, you can easily understand. So first the loans are paid and creditors are paid. After paying all the liabilities, whatever is left is the owner's right. So that is equity. So this is the basics of accounting, how accounting is done. So just to summarize again, what is accounting? Accounting is a process of recording financial transactions pertaining to a business. And how accounting is done? First, you have a transaction that you see in a source document like rent paid, we covered, and what we covered is like interest expense, loan taken. So you have a source document. You need to see the source document. That is loan taken. You have some loan document. Rent paid. You have rent receipt. So you have a source document. That rent receipt you have, or uh, you need to record. How you record? You pass a journal entry. So for rent paid, what will be the journal entry? And trust is it is your expense. Expense are increasing. Expense should be debited. Rent account debit. And another thing is two account must be used. So if you are using rent, another account is cash. Okay. So rent account debit to cash. So let's say whatever be the amount. So you prepare a journal entry, and from journal entry you prepare the accounts. So these two accounts, rent account debit. So here is a rent account. So it should be debited. So you will write it at right debit side, and cash it must be credited. So you write at the credit side. So from the journal accounts, you prepare a trial balance. The summary of all these ledger accounts are posted into trial balance, and from trial balance, you prepare the financial statements. So financial statements are nothing but the two things. Very one is P&L and another is balance sheet. But there are certain other things which I'll be discussing in some later videos. That is cash flow statements and notes to account. And then we have disclosures and statement of changes in equity. So there are many things that are at an advanced level, but the very basic, when we're talking about the basics of accounting, so at the end result of accounting is preparation of financial statements. So financial statements are nothing but balance sheet, that is statement of financial position, P&L, that is statement of income and expenditure. Then we have cash flow statement where we record all the cash, and then we have notes to accounts. That is a simple, you can say, disclosure that also form part of financial statements. And then we have a statement of changes in equity that is also form part of financial statements. So what I just taught you is the way how accounting is done in an easy way, but how it started. So the father of accounting is Luca Pacioli. The Luca Pacioli gave us three golden rules. The three golden rules is like he told us like all the account must be divided into three parts, and you follow this thing to do the debit and credit. What I told you, like assets, expense, liabilities, income, debit and credit, following that rule. But Luca Pacioli gave us the traditional rules of debit and credit. He told us first divide all the accounts into three things: real, personal, nominal, and then make entry basis on this. You can, so I'll prepare a separate lecture for this. It is not necessary to do the accounting, but for the knowledge purpose and how we can make prepare an entry basis the ultimate three golden rules of accounting that are given by a respected Luca Pacioli. And these are the basic thing, but we will learn in a separate lecture. But as I say, as I'm covering some of the frequently asked interview questions, so you can be asked, you might get these kind of question in your interview, like what are the three golden rules of accounting? So you must be aware that these are the golden. You can pause this video and learn about this. So guys, thank you for listening. In the next lectures, we will be focusing on the advanced thing. How do we record accounting entries for stocks, loans, bond, FX forward, interest rate swap, or any derivative? So these are recorded as per the IFRS 9. So first we will be covering IFRS 9, and then as per IFRS 9, how the accounting should be done, we will be doing. So in this video, that's all from my side. If you have any question, please let me know. Just do comment on the below video. I will definitely try to answer. So thank you guys. Thank you so much. Thank you for listening. Bye bye.